Welcome everyone to our High Rock. I've got some feedback, Bianca. Can you hear me? Well, welcome to our High Rock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we are going to talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for your and our investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, let's quickly recap our themes for 2016 before we get started on what happened last week. Now, our overriding theme for 2016 is that financial markets will remain volatile. January saw a significant spike in volatility, but markets settled a bit in late February and March thanks to continued monetary stimulus by central banks. Volatility did slip back to the low levels of last October, but as we head into earnings season now, volatility has picked up a little bit. The big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer is not, at the moment, providing a significant lift to the domestic economy, despite improving employment growth, and expectations for the first quarter of 2016 are now showing almost no growth at all. More on that a little later in the call. Commodity prices, and especially oil, are trending higher now after a prolonged decline. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks in a bit of a quandary as to what to do next. The European Central Bank, the Bank of Japan have pushed rates into negative territory to try and get the value of their respective currencies lower and attempt to drive their economies into growth through exports. This has backfired somewhat as the U.S. Federal Reserve has pulled back on their desire to push rates higher, at least for the time being. The U.S. dollar has fallen and other currencies have risen significantly, leaving many central banks in difficult spots because their plans are just not working. We will have a closer look at this a little later on in the call. Well, geopolitical wildcards like the UK leaving the European Union, the U.S. political situation, OPEC, oil-producing nations, China, North Korea, terrorist activity, and the refugee crisis are all increasing the levels of uncertainty. We continue to watch bond markets for clues, but with some central banks forcing negative interest rates, that picture may be being distorted somewhat. Now, as we move into the release of first quarter earnings results, also known as earnings season, over the next month and a half or so, expectations are for a fourth consecutive quarter of negative growth. The last time earnings growth had 4 consecutive quarters of negative growth was 2008, 2009. Yet stock markets remain only about 3% off of their all-time highs. Now, we think that this and a number of other metrics suggest that they are expensive. We remain in a time of lower than average returns when, after 6 years of above average returns, and as the cycle evolves, longer term returns are moving back toward the average. The total return, including dividends, on our benchmark all-country world index is about negative 8% over the course of the last year. The total return on the Canadian bond index is a positive 0.75% to that same period. Meanwhile, most of our client portfolios are at or about the break-even point over the last year. depending on the structure of your portfolio and, of course, depending on the timing when you joined. Well, let's have a look at what has transpired over the last week. Now, in keeping with our theme for 2016, it was a wild ride in January and part of February. However, volatility eased up through March as the People's Bank of China, the Bank of Japan, and the European Central Bank added further monetary stimulus, and the U.S. Federal Reserve lowered expectations for higher rates. Growing uncertainty over the last week or so has seen volatility move a little bit higher. But volatility remains below its long-term average. CNN Money's Fear and Greed Index hit a low near 9 in January, but now it has moved back into the greed territory as more stimulative central banks have forced money out of safe assets and into riskier assets. Markets moved rather quickly from oversold to overbought. We suspect that the next move is likely to lower prices. Well, since our last webinar, our benchmark World Equity Index is stronger by about 2% and is now slightly positive on the year. Last week, it was actually slightly negative. Emerging markets were the best performer since last Tuesday. China's Shanghai Composite Index was the worst performer. Now, the strategy that we initiated back at the end of 2015 to be overweight the Canadian equity market and underweight the U.S. equity market for rebalancing purposes continues to be favorable. On a total return basis, which includes dividends and currency fluctuations, the TSX is up by 6%, while the S&P 500 in Canadian dollar terms is lower by about 5.75%, which is a difference of about 11.5% in our favor. So that is working quite nicely. Now, the TSX has been the best performing country index in the developed world this year, as the Canadian REIT index has also done very well. We also have an allocation to that asset class in our global equity market. Well, after hitting highs last May near 63, our benchmark World Equity Index made new lows near 49 in mid-January and then again in early February, which was about a 22% drop from the highs. Then it found support from short covering and a little value investing after that pretty significant decline. Now, at the moment, the top of the down channel is being tested with some buying. 2 weeks ago, it tried and failed to break through, and subsequent selling pushed prices a little bit lower. It's bounced back over the last couple of days. I'll get to that more in a second. But at this time, the downtrend channel remains intact as we continue to see lower lows and lower highs. And until this pattern and the downtrend is broken, we should be on guard for further selling pressure. Now, trading volume continues to remain low. Without volume follow-through, it will be difficult for the market to sustain any upward momentum. Now, as we enter earnings season, expectations are quite low, so it is not impossible that if they come in better than expected, there may be some relief buying. However, until we see positive developments and a change in the trend, we will be sticking to our overweight cash thesis for our equity models. Preferred shares had a good week, as did U.S. high-yield bonds, as investors added risk to portfolios with the improvement in oil prices. U.S.-Canada 10-year yield spreads narrowed a lot this week. As concerns about the first quarter economic growth in the U.S. were amplified, and the employment picture in Canada actually improved. So the spread between the 10-year Canada and the 10-year U.S. government bonds narrowed by almost 11 basis points from 59/100% to 48/100%. Well, speaking of oil prices, they jumped way up this week. Oil found buying support last week and has resumed its new uptrend after breaking out of the downtrend channel that existed from 2014. Output from U.S. shale formations will drop to the lowest in almost 2 years, according to a report Monday from the Energy Information Administration. Lower supply expectations are helping prices move a little higher. The market is also encouraged by the news that OPEC countries and Russia will meet to discuss an output cap on April the 17th. Rumors of an agreement between Russia and Saudi Arabia on a production cap were driving prices higher today. And the Bloomberg Commodity Index has continued its uptrend after finding support at the bottom of the new uptrend channel. Well, our benchmark World Equity Index is comprised of about 53% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. The U.S. Federal Reserve modified their expectations for higher rates back in March as economic conditions remain under pressure, and as I mentioned before, the GDP Now model forecast for real GDP growth in the first quarter of 2016 is only at 0.4%. So that's significantly lower than market expectations had it at somewhere in the vicinity of 2%. This decline is due to declines in the forecast for real consumer spending and real equipment investment and growth. So the consumer is not spending, and the consumer is 2/3 of the U.S. economy. So that is definitely not a good sign. At the moment, it appears that the U.S. economy is not providing the support for the global economy that many had hoped for. So let's have a look at what is happening in the global economy. Well, in general, there was an eerie calm that had settled over financial markets as we waited to see what the next round of economic data would bring after all the monetary stimulus from the European Central Bank, Bank of Japan, and the People's Bank of China. Early results are looking a little grim for the Eurozone and Japan, and slightly better for China, although it may take a little more time to get a better reading on what comes next. In the meantime, the International Monetary Fund has once again lowered its global economic forecast. The world economy will grow 3.2% this year, down from a projected 3.4% in January. The IMF said today in a quarterly update to its World Economic Outlook that the biggest risks are a return of financial turmoil itself, impairing confidence and demand in a self-confirming negative feedback loop. Yikes. Well, as you all may be aware, the broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective. So we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. The U.S. has more than 1/2 of the companies. Europe has about 16%. Japan has 7.5%. The U.K. has 6.5%. Canada has 3%, and China about 2.5%. As we have discussed here each week at some length, central banks have been attempting to jumpstart their respective economies with stimulative monetary policies, and in some cases, aggressively so. The hoped-for result for each of these countries has been a lower value for their currency and an equally hoped-for rise in their exports to fire up economic growth, and at the same time, exporting deflationary pressures to the U.S. But negative interest rates have not worked in Japan, as the Bank of Japan's concerns have fueled investor worries, and capital has moved to safe havens, driving up the value of the yen. A similar situation has occurred with the euro. This is all happening as the U.S. Federal Reserve has backed off of their desire to raise interest rates, fearing that global economic pressures and imported deflation will stall the U.S. economy, and they are fighting back with a devalued U.S. dollar. There is deep concern among investors that the global economy continues to stall and that the central banks have run out of tools to do anything about it. The IMF has echoed this in their reduced economic outlook. Well, here at home, better than expected employment data for March and higher oil prices have driven the Canadian dollar to new highs for 2016, above 78 cents US. The Bank of Canada will be happy with the growth in employment. However, it is important to remember that this data can often be significantly revised from month to month. In the meantime, a stronger Canadian dollar will work against export growth and like Japan and the euro area, put greater risk on the future of Canadian economic growth. The Bank of Canada will announce their latest interest rate decision tomorrow. So what do we see going on out there? Well, let's have a look at what bond markets are suggesting. Each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, the UK, and Canada, should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against potential future inflation. Negative yields below the red zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. All the yield curves have been flattening over the last little while. That is not what we would classify as a good sign. And if we look at the history of U.S. interest rates, the times when the 2-year, 10-year, and 30-year yields are the widest apart reflect the most positive sloping yield curve. When the Fed raises rates, the 2-year yield rises much more quickly than the 10 and 30-year yields, which flattens the yield curve considerably, and typically a recessionary period ensues. At the moment, the spreads between the three maturities remain relatively wide, but you can see why we focus on the U.S. Federal Reserve so closely, because usually when they start to tighten policy and raise interest rates, a recession is not too far away. With many other indicators pointing in that direction, they will have to be very careful if they do not want to trigger another recession. Historically, high-yield bond markets lead equity markets, and while the current gap remains to be closed and makes equity markets still look relatively expensive, the gap has narrowed as record inflows into high yield have narrowed the spread to equities. Canadian high yield, though, continues to lag U.S. high yield in the most recent rally. A few weeks ago, Paul talked about the potential of increased defaults in the energy sector to impact the financial system in the longer term. Now, we are watching developments here quite closely. In an article in today's Wall Street Journal, it was suggested that there will be increased scrutiny on bank earnings when big banks announce earnings starting on Wednesday of this week. The spotlight will be on massive energy loans that most investors didn't know much about until recently. Now, these unfunded loans have been promised to energy companies that haven't yet tapped the money. Many banks historically haven't disclosed these loans, but have begun to recently, following the extended slide in oil and gas prices. In the first quarter, a handful of energy borrowers announced more than $3 billion of drawdowns against these types of loans. Now, those commitments are expected to trickle down to bank earnings and saddle firms with more energy exposure at a time when they are trying to pare it back. It is one reason that higher oil prices provide a little bit of relief to the markets in general. Well, as for equity markets, some investors are still buying stocks, driving prices higher as they seem to be comfortable adding riskier assets to their holdings. That is not the case where we are concerned, and here's why. When investors do buy stocks, they buy a stream of future earnings. Now, the price to earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.2 times. The 12-month forward price to earnings ratio is currently at an expensive 16.7. Last week it was 16.6. At the equity market highs back in May of 2015, it was 17.1. So we're not that far off those highs. Well, it is earnings season, and as a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is now 9.1%, which is below the expected earnings growth of 0.3% at the end of 2015. It would, as I mentioned before, be the fourth consecutive quarter of negative earnings growth. On average, approximately for all of 2016, analysts are projecting earnings increases of 2.1%. At the beginning of the year, analysts had projected 2016 earnings growth of 7.4%. When companies in the S&P 500 report actual earnings above estimates during an earnings season, the overall earnings growth rate for the index increases because the higher actual earnings per share numbers replace the lower estimated earnings per share numbers in the calculation of the growth rate. For example, if a company is projected to report earnings per share of $1.05 compared to a year ago, earnings per share of $1, the company is projected to report earnings growth of 5%. Now, if the company reports actual earnings per share of $1.10, that's a 5-cent upside earnings surprise compared to the estimate. The actual earnings growth for the company for the quarter is 10%, 5 percentage points above the estimated growth rate. Now, over the past 4 years, on average, actual earnings reported by S&P 500 companies have exceeded estimated earnings by 4%. During the same time frame, 67% of companies in the S&P 500 have reported actual earnings per share above the mean earnings per share estimates on average. In essence, many companies understate earnings expectations to try and look better when they actually announce. Well, as a result, from the end of the quarter through the end of the earnings season, the earnings growth rate has typically increased by 2.8 percentage points on average over the past 4 years due to the number of and magnitude of upside earnings surprises. This average increase is applied to the estimated earnings decline at the end of the first quarter, March 31st, which was negative 8.6% at the time. The actual earnings decline for the quarter would be negative 5.8%. That's minus 8.6 plus the 2.8% higher than expected equals the negative 5.8%. So if negative 5.8%, is the actual earnings decline for the quarter, it will still mark the largest year-over-year decline in earnings for a quarter since the third quarter of 2009, which was negative 15.7%. Now, we also need to focus on forward guidance for future earnings and revenue. Yesterday, Alcoa beat earnings expectations. However, they offered forward guidance that was for considerably slower revenues down the road. The recent rally in stocks has pushed the enterprise value to earnings ratio back toward 13 times and well above the longer-term average near 10.7. This prompted us to take some sales to further lighten our exposure to expensive U.S. equities. Corporate profitability, the white line, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time. In fact, it looks like an elastic band that's been stretched too far. Historically, corporate profits have turned lower preceding a recession. Corporate earnings growth has been declining in the previous 3 quarters and is now expected to fall in the first couple of quarters of 2016. So these 3 indicators leave us more than a little concerned about the state of the U.S. economy as we move forward. As we've talked about many times in the last few weeks, corporate buybacks may be distorting the picture as stock prices remain lofty despite a low level of positive investor sentiment. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. The most recent data show that the trend is continuing and keeps us very cautious. And when the spread between large cap markets like the S&P 500 widen over the small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. When markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied more than the broader Russell 2000 has. Well, the broader Russell 2000 has lagged. This, again, invokes caution. So what does it all mean? Well, since last May, and as we have told you every week pretty much since then, we have taken a cautious and defensive posture to investing. And in light of our key theme for 2016, we still remain defensive. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. Now remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, your risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategies that we make in our models, which we believe add value to the long-term performance. And that is how we justify fee. Our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and a tactical mid and small cap companies model. Because our key theme for 2016 is focused on greater levels of volatility in the cash or cash equivalent component in the client account, and the underweight exposure to equity markets and the overweight exposure to safe government bond markets helps to mitigate the impact of volatility on our portfolios. As I mentioned earlier, over the last year, the benchmark All Country World Index is down some 8% over the last year, whereby our client portfolios are pretty close to the break-even level. So again, emphasizing how our strategy is protecting our clients. Now, also, our tactical model has taken advantage of some value purchases so far this year, like buying Rona before it was taken over by Lowe's at 100% increase, and picking up some cheap shares in Paramount Energy before it tripled in price, and we sold it. This is how we can add value to our clients' portfolios and help to get growth at the best risk-adjusted returns that we see possible. On an administrative note, it is and has been the end of the first quarter of 2016. Quarterly reports have been sent to you, and any feedback that you may have for us would be greatly appreciated. As is our policy, it is important to us to be able to sit down with you at least 2 times each year to have a detailed discussion of your current financial situation and determine if we need to make any portfolio strategy adjustments. If there are any major changes in your circumstances, or if you have a question or concern you need to discuss, we are always available. Well, what's up for next week? Well, in the Euro area, tomorrow in the Euro area, we'll see February's industrial production numbers. In the U.S., we'll see March retail sales, which gives us a little more insight into what's going on with the U.S. consumer, which is very important to that economy. We also have the Bank of Canada's interest rate decision and their monetary policy report. We've been waiting for this since the budget to know exactly how the Bank of Canada perceives what to do next, so we'll be watching that closely. On Thursday, we'll see March inflation data for the Euro area. We also, on Thursday, will have the Bank of England making their interest rate decision. We'll see a little bit of U.S. inflation data for March, and very important data from the first quarter of the Chinese economy with their GDP, March industrial production, and March retail sales. On Friday, we'll get a little bit of insight into Japan's February industrial production, and in the U.S., the March industrial production. Next week, rather quiet, but the IMF and World Bank meetings in Washington and the meetings of G20 finance ministers will be going on, so we may get some information from that. And then on Tuesday of next week, we'll see a bit more data from Japan as far as their trade is concerned. And of course, the High Rock webinar next Tuesday. Well, that's it for today's discussion. If anyone who is listening might have a question, please feel free to ask it now. No questions for me this week. Well, if you do have a question, you wish to email us, we would be more than happy for you to send them. We also would love to get your feedback on these webinars, what you think is good, what is not, or what else you might like to see us talk about on these calls. But as always, we really appreciate you taking the time to tune in. Have a great rest of the week, an excellent weekend, and don't forget to tune in next Tuesday. And until then, this is Scott Tomlinson signing off.